This chart shows that, historically speaking, for decades, the real economy and the financial economy did move hand in hand. I know there's a lot of people out there say Wall Street isn't Main Street and Main Street isn't Wall Street, and I get those arguments. But when you look at the data, Wall Street and Main Street, the real economy, the financial economy, do tend to move hand in hand until ChatGPT launched in late 2022. But yeah, you're right. That's why you got to follow the technicals. As soon as we start to see technical weakness, yeah, time to get out. If we break the 200-day moving average at elevated valuations that we're at right now, with all the macroeconomic concerns that are burgeoning across the board, that would probably be a sell signal. So watch the 200-day closely. Don't be a slave to the technicals, but
Right.
follow them very, very closely. That's going to be your most important signal for when this market might have topped out.
Hello and welcome to Being Exponential with Luke Lango, where we'll discuss the economy, markets, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is October 1st, and let's dive right in. Okay, Luke, never a dull week. The government just shut down midnight, just a hair after midnight tonight. We're not sure what to expect with this one, but we know it does affect the way we work a bit. With this shutdown, the BLS will not be able to report on Friday, and there's a bevy of other factors. Now, what's your take on this recent shutdown, Luke?
Okay, well, the shutdown is a sign of the political chaos in Washington, D.C., but market wise, it doesn't matter. In terms of what it means for the stock market, for your investments, I don't think it matters at all. I think it's a nothing burger. Um, the threat of a shutdown, that kind of happens every single year. Actual shutdowns, less common, but they happen about once every 3 or so years. We've had 14 shutdowns since 1981. In fact, I got the data pulled up right over here. We can screen share that. You can see we've had 14 different government shutdowns since 1981. They never last long. The average duration is 7 days. The max duration is 34 days. So the longest the government's been shut down is a month. The average duration is a week. Not much damage can be done in a week, 2 weeks, 3 weeks, or 4 weeks. Really, not much damage can be done. Even if it were significant damage, the duration limits it, the volume of it, the magnitude of it, but it's not significant damage. Look at the performance of the S&P 500 on the day the government gets shut down. Up 0.8 in 81, down 1% in 82, up 1.6 in 82. These are plus or minus, minus 2% to plus 2% on the day of a shutdown. For an average return, this is my favorite stat, the average return of the S&P 500 on the day the government gets shut down or the day after is 0%. A whopping 0%. Now, during the shutdown, I mean, similar results, right? You're down 0.1% in those 2 days. It got shut down in 81. You're up 0.9% in the day it got shut down in 82, up 0.8 during the 3 days it was shut down, December of 82, et cetera, et cetera. Sometimes you're down as much as 2%, and sometimes the most recent shutdown back in December 2018, you're up 10%, more than 10%. Average return during a shutdown for the S&P 500 plus 1%. So there's not much that happens to the market historically speaking in shutdowns. Sometimes stocks go up, sometimes they go down, sometimes they go sideways. There's nothing meaningful. There's no pattern. There's no trend in the action of stocks during a shutdown. Same is true for bonds. Same is true for treasuries. Same is true for the dollar. It's just kind of erratic, sporadic, not consistent. No signal in that. Just a bunch of noise. So in terms of the stock market implications of the government shutdown, I think it's a nothing burger. It looks like the prediction markets are suggesting the shutdown will last until at least October 15th. So this might be on the longer side, going somewhere between 15 days to 30 days. if you kind of look at the precedents for that duration of a shutdown, you got one in December 95, 21 days. Stocks were essentially flat during that shutdown, up 0.3%. You had a 16-day shutdown in 2013. Market actually rallied 3% during that shutdown. Then you got that 34-day shutdown in 2018, late 2018. Then you got a 10% rally during those 34 days. So a big rally. And that had nothing to do with the shutdown. It wasn't because of the shutdown or in spite of the shutdown. The market was rebounding. It had that big, nasty 2018 crash because the Fed was hiking rates and the market couldn't take it. And so the Fed kind of said, we're done hiking rates. We're going to provide some accommodation. And the market rebounded like crazy. December 24th, I think, was the day when everything turned around. So that was just right at the bottom of a big crash and big reversal. That's why we got the 10% rally in 34 days. Point being, shutdowns don't really move markets. I don't think this one will move markets. I think it is a sign of, like I said, political chaos in DC. I think it's a sign of fraying relations, if you will, in DC and throughout the political structure of America. Those might have some longer running consequences and implications to them. But in terms of the short term market implication, medium term market implication, even, I don't see anything to be worried about with this shutdown. I think it's resolved in the next 2 to 4 weeks. I think the market does its thing in those next 2 to 4 weeks. And then I think AI stocks continue to lead this market higher into the end of the year. I'm not giving really any weight to the shutdown in terms of our analysis of the market.
Very well. All right, let's move on. I want to discuss AI stocks again. Well, that was a big topic last week, with the Nvidia OpenAI deal. However, several AI stocks have gone down by double digits. It is a bit worrying. I know we talked about potential signs of a bubble. Other articles have popped up and some commentary on the fringes. One article, for example, said a lot of the AI value has become work slop. That being companies use AI, but that AI work has to be fact checked by other people, so it's slowing down companies and overall almost a net negative in some instances. Do you think this is a buy the dip opportunity? Is this signs of that bubble showing, or should we be concerned? What's your take on that, Luke?
Yeah, I would say it's a buy the dip opportunity in AI stocks. We are definitely seeing a divergence between the real economy and the financial economy. We've talked about this multiple times on this podcast. The real economy is struggling because of high rates and high inflation, stubbornly high rates and stubbornly high inflation. The financial economy is booming because of the AI spending tidal wave coming out of the hyperscalers, out of the biggest tech companies in the world. So there's a bifurcation within the economy, a big divergence between the financial economy and the real economy, or as I like to say it, the AI economy and the everything else economy. This chart really captures it very well. So we got another job openings report this week, a JOLTS report this week. Job openings remained pretty low across the US economy. This chart shows that, historically speaking, for decades, the real economy and the financial economy did move hand in hand. I know there's a lot of people out there say Wall Street isn't Main Street and Main Street isn't Wall Street, and I get those arguments. But when you look at the data, Wall Street and Main Street, the real economy, the financial economy, do tend to move hand in hand. The blue line graphs U.S. job openings across the entire U.S. economy. The white line is the S&P 500. They track each other. In the early 2000s, during that dot-com crash, job openings were falling. So was the S&P 500. Then we bottomed in, late 02, early 03. Job openings rebounded. We had that steady uptrend, and the S&P 500 rebounded and had a steady uptrend into about 07. And then job openings started to fall over and then crash. And the S&P 500 did the same thing. It kind of started to fall over and then it crashed. Then in late 08, early 09, job openings bottomed, stocks bottomed, and we had secular growth in job openings and the S&P 500 all the way until COVID. Then we got that big crash during COVID, and we had a big crash in job openings and stock prices. Then the big rebound, right out of COVID in job openings and stock prices. And then in 2022, early 2022, job openings started to peak out, move on lower. S&P 500 2022 peaked out, or early 2022 peaked out, moved on lower. So these two have moved hand in hand for the last several decades until ChatGPT launched in late 2022, November 30th, 2022. That's when ChatGPT launched to the world. Since then, the S&P 500, the white line here, has risen 70% to all-time highs, while job openings have actually dropped more than 30% to 7.2 million. So since ChatGPT launched, an unprecedented divergence between the real economy job openings and the financial economy stock prices has emerged, with stock prices soaring 70%, AI economy, financial economy booming, and job openings dropping 30%, real economy, everything else economy struggling. This is the power dynamic, the most important power dynamic at play in the market today, because it's kind of like a scale. Okay, on one side you have this booming AI economy, on the other side you have this struggling real world economy. Just this week, today we're recording this on Wednesday, October 1st, just today we got that super weak ADP, September ADP jobs report. The US economy lost 32,000 jobs in September. Expectation was for a gain of 51,000. Last month's number, August numbers, were revised lower from a gain of 54,000 to a loss of 3,000. So the economy's now lost jobs in back-to-back months. That's only the third time in the last 15 years that has happened. ISM manufacturing once again came in below 50 for the month of September. 49 was the reading. In 33 of the last 36 months, that ISM manufacturing index has been below 50. 33 of the last 36 months. That is the worst stretch for the ISM manufacturing index in history. We never in history, going all the way back to 1950, have had a stretch where 33 of the previous 36 months registered a reading below 50. That's never happened before. So real weakness in the everything else economy, but also a ton of strength in the AI economy. This week we got Sora 2 out of OpenAI. Very cool video app where you can essentially create your own TV shows and movies and inject yourself and your friends into them. That's fabulous. Morgan Stanley came out with a report saying, these retailers can save billions upon billions. He said $6 billion can be saved in costs by retailers using AI, boosting EBIT margins by 200 basis points and lifting 2026 EBIT estimates by about 20%. That's Morgan Stanley research. We're having a lot of growth in the nuclear sector, a lot of growth in the quantum sector. So there's just really good stuff happening in AI. When we go to this scale, the AI boom strength is very strong. Let's call it 10 out of 10. The real economic weakness, I'd probably like a 3 out of 10. So you got a plus 10 and minus 3 for a net plus 7, let's call it. That's why the primary trend for the market is higher. So long as the net rating between the growth in the AI sector and the struggles everywhere else, the net rating between those two is positive, the primary trend for the market will remain higher and AI stocks will continue to lead the charge, and every dip in AI stocks is a buying opportunity. But that will not remain true forever. I think the scales will tip eventually. I think within the next 12 to 24 months, not within the next 12 months. I think for the next 12 months, AI strength is going to stay 8, 9, 10 out of 10. Real economic weakness will stay 2, 3, 4 out of 10. Net rating will still be positive. The market will push higher. But when we look 12 to 24 months down the line, 36 months down the line, I think the scale shifts. The AI boom slows because you can't keep up that spending forever. The 8, 9, 10 turns into 5, 6, 7. Meanwhile, I think real economic weakness does spread. I don't think lower interest rates are going to flow into lower mortgage rates, lower auto financing rates. I think the long end of the curve is kind of stuck at elevated levels because of reinflation fears, because of money printing fears. Look at the gold market, look at the silver market. These things are absolutely soaring right now. The reason for that is because they're worried about reinflation. They're worried about fiscal responsibility. They're worried about money printing. So I don't think the long end of the curve moves much lower. And I think real economic weakness goes from a 2, 3, 4 right now to a 4, 5, 6. At that point, the scale will be equal. And then Wall Street's focus will shift from, wow, look at all this growth in AI to, uh-oh, look at all this weakness everywhere else. Again, that scale is going to tip in the next, I think, 12 to 24 months. That's going to be your cue to get out of stocks. But I don't think it's here and now. I think here and now AI strength is so much stronger than real economic weakness or everything else economic weakness that the market's primary trend will remain higher and AI stocks will keep bouncing back. And a lot of the names that we follow here, Oklo, Bloom Energy, Astera Labs, Credo Technologies, IonQ. These are stocks that have been hit pretty hard over the last week or so. I think they're buying opportunities. And they're going to rally again. Then they're going to get hit pretty hard, 3 months down the line. That's probably going to be a buying opportunity. These things are going to be 2 steps forward, 1 step back for the next, I think, 12 or so months. So you're going to want to buy all dips in AI stocks. That's my 2 cents at least.
Gotcha, Luke. It is pretty interesting because this is essentially a new paradigm in the market. AI completely shifted a lot of things. So I see what you're saying about 12 to 24 months from now, but how can we even track the buoys or what we should be looking out for? I know previously you mentioned a frothy IPO market for a potential crash, but there's so many varying factors. For example, in our own backyard in Baltimore, one of the counties, the citizens blocked the development of a data center because of worries about costs and electricity prices and things of that nature going up,
Right.
where we got stories of that happening on the fringe. So how do we what are we actually looking for to prevent losing our shirts in a potential AI market bubble?
Yeah, so here are the oars in the water that I'm watching. And I think they have the potential to all converge at once within the next 12 to 24 months and bring an end to the AI boom. Number one is, as you mentioned, the IPO market. 1999, late 99, early 2000 was characterized by an IPO frenzy, the hottest IPO market of all time. And you had these dot-com startups that were worthless were going public with these massively inflated valuations. And when they reported earnings in their first or second, calls, investors realized, wait, there's no real business here. There's no real money. This is crap. We paid up for crap, and it all blew up. That's what I'm so number one, I'm watching the IPO market. The IPO market currently is thawing. It was frozen throughout 2022, 2023, and 2024. It is thawing now. But the first wave of companies that have gone public in this thawing, they're pretty good companies. CoreWeave, Circle. I think these are good companies. Figma. These are really good companies. They're not companies that are going to blow up. So that's not what I'm worried about. What I'm worried about is these companies, they are the big cruise ships that cast a massive, massive wake for a bunch of small, crappy boats to kind of float behind them. I'm worried about that wave. I'm worried about the second wave of IPOs that come through, these AI startups that they're not CoreWeave generating billions of dollars in revenue. They're not Circle at the epicenter of a massive stablecoin revolution. They're not Figma that's created arguably the best, AI production editing video tool out there. No, these guys are AI startups that claim to be saving the world via doing X, Y, and Z, have no revenues, have very little cash in the balance sheet. Anything they did raise was through an IPO, and they burned through it really quickly. I think we'll get a wave of those startups in the next, by late 26, I think we're going to get an IPO frenzy in those startups. That's something I'm worried about, or I'm watching. I would say right now it's a yellow flag waving there, not a red flag at all. Number two is the M&A activity. AOL Time Warner, right? That was like a big deal that kind of characterized it became a poster boy for the peak of the dot-com boom. Big M&A happens a lot at bubbles, the peak of bubbles. We're seeing some M&A right now, not a ton of M&A. Obviously, EA had the $55 billion leverage buyout LBO. That's big, but not bubble big. We're not seeing enough of those yet. So I don't think the M&A market is really getting to a point of euphoria just quite yet. I think we still have a green flag in the M&A market. So I'm watching those two things. I am watching the technicals in the stock market. I'm seeing how we're behaving relative to the 50-day moving average, the 100-day moving average, the 200-day moving average. The thing I really pay attention to is the slope of the 200-day moving average, as well as the slope of the 100-day moving average. Those look great right now. There are no concerning signs in the technicals to suggest that a rollover is imminent. So I think green flag on technicals. I'm looking at earnings estimates. Earnings estimates right now continue to trend higher, especially in the tech sector. I'm not seeing any flatlining of estimates growth. I'm not seeing any curl lower in the estimates trend. I'm seeing a lot of positive revisions. Until that slows, and it's not slowing at all right now, I think this market pushes higher. I think we have a green flag there. So these are the various things that I am watching. I'm also looking for circular financing deals. We talked about the OpenAI Nvidia deal. That's kind of circular financing because Nvidia invests in OpenAI. OpenAI goes and builds data centers with that money and then turns around and buys Nvidia chips. So it's kind of money moving from one pocket to the other back to the same pocket it originated in. Circular financing deals were a big component of the dot-com boom. You had these massive telecom companies building out the internet infrastructure. They would loan out money to smaller firms, carriers that would buy their telecom services, which would make it seem like there was big demand for their telecom services, but that demand was being financed by the big telecom firms themselves. That eventually blew up. So circular financing deals are something I'm watching. I'm only seeing one so far, so maybe a yellow flag there. But if we see more of those, that would be a peak sign, if you will, a peak euphoria sign. So these are the things that I'm watching. And as you can tell, across the board, there aren't really any red flags waving.
Mhm.
There are some yellow flags, but a lot of green flags still waving in the market. Inflation is something we are watching. We're at 3% essentially on CPI. Wage growth is 3.9. We've talked about it. You know, when that flips over and inflation overtakes wage growth and you get negative real wage growth, that's concerning. So we're watching that, of course. We're watching the 10-year Treasury yield. Any movement toward 5% on that would be pretty catastrophic. Right now, we're hovering at 4.1. So again, yellow flags across the board, some green flags, but I'm not really seeing any red flags. And that's why I'm pretty confident in saying, you know what, this is still a buy the dip moment. This is a buy the dip market, buy all dips in AI stock. So that's what I'm looking for. And again, I'm not seeing anything to suggest time to run for the hills, though I am monitoring all of these risks very, very closely.
Sounds good. I gotta ask, with the nature of the market, everything moves a lot quicker now. It seems like, is that something we're worried about? Where we have a 12 to 24 hour, 24-month window, but could it contract suddenly? Is that something to be concerned about?
Oh, absolutely. And that's why the thing to watch above all else, I should have listed it first, if I'm being honest. The thing to watch above all else is the tape. You got
Mm,
to watch the technical conditions. You got to watch the price action. Things move very, very quickly these days. You are 100% right. Everyone has access to a computer. Everyone has access to a phone. Everyone is connected. Money moves at lightning speed these days. Maybe you don't have time to wait for Bloomberg to update their numbers on the IPO
right.
market this month or this week. Maybe you don't have time to see what the earnings estimates. Earnings estimates are notoriously a lagging indicator. So, no, the thing you really have to pay attention to is the tape. Watch the price action. Price is truth. Do not fight the tape. The tape
Mm,
right now has a relentless bid under it. It's shut down day to day, and we're up 30 points on the S&P 500 as of this recording. The tape has a relentless bid to it. Don't fight that bid. Ride that bid higher. Keep on pushing higher with AI stocks. But yeah, you're right. That's why you got to follow the technicals. As soon as we start to see technical weakness, yeah, time to get out. If we break the 200-day moving average at elevated valuations that we're at right now, with all the macroeconomic concerns that are burgeoning across the board, that would probably be a sell signal. So watch the 200-day closely. Be Don't be a slave to the technicals, but
right.
follow them very, very closely. That's going to be your most important signal for when this market might have topped out.
Gotcha. All right. Let's move on, or I guess move back to the government. I want to talk about White House investments. One article roughly summed it up as an Uncle Sam ETF, if you will. So we had the MP Materials deal way back, almost $500 million. We had Lithium Americas recently, where the government took a 5% equity stake in that company. Intel, they took a 10% equity stake at around 10 billion. And most recently, the government just struck a deal with Pfizer to create what they're calling Trump RX. It's sort of a website where citizens can buy drugs at cost. Now, who was next? All of those companies in question shot up massively. Are there more companies we should be on the lookout, Luke? What do you take of this almost heavy government hand in the market with certain stocks?
Well, it's definitely happening. You called it Uncle Sam's ETF. I like to call it the president's portfolio. Um, that's what he's doing. That's what the Trump
Yeah.
administration is doing. Is they're building out a portfolio for the president, for the White House, for the U.S. government. We're three deep right now. MP was first, Intel was second, LAC Lithium Americas was third. So we've got a rare earths metals miner and magnets maker. We have a chip maker, foundry type play, and we have a lithium miner. That's just the start. Those are the first three dominoes to fall. There will be more and more dominoes to fall over the next 12 months. I think it's gonna happen very rapidly. These three deals have happened in 3 months. We talked about the first one when it happened with MP. That was back in July. We're in October now. 3 months hence, we got three deals. So we're basically averaging a deal a month. And I think they're going to keep going at about a deal a month for the next 12 months. They're going to build out this portfolio to 10 to 15 positions across the entire AI value chain, from digging crap out of the ground, digging metals out of the ground, all the way to the finished product. I think in this case, Palantir. I think Palantir and the US government are going to tie up in a massive deal. White House officials have said they want a piece of Palantir. Alex Karp seems at least somewhat amenable to the idea. So I do think that Palantir gets thrown into the president's portfolio, Uncle Sam's ETF, whatever you want to call it. So that's four. Now, the value chain, though, there's a lot of steps in between, rare earth magnets and or lithium metals and Palantir's end software. There's a lot of stuff in between. There's foundries, there's EDA software, there's cooling equipment for data centers. There's energy, the power backbone. I think that's going to be a massive one. I think, we may have to nationalize some of these energy things. You were talking about all the energy demands of AI. I think Bloomberg came out with a piece this week that talked about energy prices around data centers in America. So if you're in an American town that's by a data center, energy costs on average have gone up about 300% over the last 5 years, and those costs are being passed on to consumers. And the rise is super pronounced in these areas with data centers close to them. It's much less pronounced in areas where there aren't data centers close to them, which is interesting because in areas where there aren't data centers, those are the very congested areas, the very urban areas, the ones with high energy usage. They're building data centers not in downtown San Francisco or downtown New York City or downtown Miami. They're building them in the outskirts of Phoenix. They're building them in Virginia. They're building them in rural places. So these places do not have traditionally high energy usage, yet that's where energy costs are soaring. That's a problem. That's a massive problem. AI has the potential to be massively deflationary in the long run because of its productivity benefits, but it could be massively inflationary in the next 1 to 3 years because of its huge energy demands. Energy demand goes up, energy prices go up. We're already seeing that. So I think the government makes a play on energy, whether it's going after an IPP like Constellation or Vistra, or whether it's going after a nuclear company like Oklo or SMR. I think the government makes a play here, maybe makes multiple plays here. So again, when you look at the whole value chain, I think, okay, they got one, two, three right now. I think Palantir is four, and then you kind of fill it up with another maybe 11 to 12 positions, or 10 to 11 positions. That's another 10 to 11 stocks that could absolutely soar by becoming a part of the president's portfolio. Look at what these stocks have done. Intel stock. It went from about 20 to $35. So what is that? That's I don't want to do the math in my head. Is that a 75% rally? What is that? Help me.
Yeah,
Why is my
70.
math awful?
Close
Uh,
to 100. Let's call it.
it's 75%. I'm too reliant on computers these days. Anyways, so Intel goes up 75% by joining the president's portfolio. MP tripled in a matter of like 2 months because of
Yeah.
joining the president's portfolio. LAC jumped 100% in a single day and is continuing to rally even more. I think it's up now 120, 130% in about a week or two because it's joining the president's portfolio. These are huge returns. We're not talking a 10% jump. We are talking a 75% move in Intel, a 200% move in MP, 130, 140% move in LAC. And these moves are happening in a matter of weeks. Maybe the best investment strategy for 2026 is to say, okay, what are the other 10 companies going to be in this president's portfolio? Let's position ourselves for that. So, how do we do that? How do we answer that question? Well, I'm still researching right now to find out specific tickers, but what I'm looking for is one, the overlap really of mission critical part of the AI value chain
Mhm.
and where we are heavily reliant on foreign actors in that
Right.
step of the value chain. Look at MP, look at LAC, MP, rare earths, right? Rare earths, super essential to the AI value chain. Yet 90% of that shit was coming from China. Boom, makes MP a super obvious target for America. Go and, support them, build out a domestic source of that stuff, nationalize more or less that part of the value chain for America. Okay, cool. LAC, Lithium Americas. We need a lot of lithium metals to support all of our technology efforts, including AI. A lot of that stuff does not come from America. Okay, so let's go after LAC and let's support them. Intel, Foundry, right? All the chip making happens outside of the US. We need more chip making in the US. White House goes after that. So what you have to find is, and I guess the third piece of that Venn diagram is like an American-based company, obviously.
Mhm.
So you have to find an American-based company with American-based operations, American-based manufacturing, production, whatever it is. You got to find a company that's an essential part of the mission critical value chain, and you got to find a company that's operating in a step of the value chain and a part of the value chain that is heavily dependent on foreigners right now, heavily dependent on China, on Southeast Asia, on other parts of the world. That Venn diagram, when you kind of draw it all out, it's not a lot of companies in the overlap. And if we're talking the White House takes another 10, 11, 12 positions here, maybe that Venn diagram overlap, we're digging in right now, maybe that's 20 to 30 companies. So if 10 of those get put into the president's portfolio, you have a one-third chance of just closing your eyes and throwing a dart at one of those companies, okay, and being right. If you do your homework and you do your research, obviously you can increase your odds there. So I think there's a really compelling investment strategy here of let's just get in the way, more or less, of this White House AI investment of this president's portfolio. Let's find stocks that are going to get put into that before they do get put into that, so you could potentially get a 100% move in a day, or a 200% move in 2 months, or a 75% move in a few weeks. Seems like a good strategy to me.
Agreed. Um, let's move on to the next topic here. I want to talk about quantum stocks. So
Okay.
HSBC recently had a innovation, what they're calling a Sputnik moment. They had a quantum computing machine beat other Wall Street rivals at pricing bonds. Now the interesting here is usually innovations in the bond market or beating your competitors are roughly 1 to 2%. That quantum computing machine gave them a 30% increase over their competitors, which is uh, light years. That's amazing. So if this is the case, why are the stocks dropping?
Yeah, so I would say the stocks are dropping for reasons related to technicals and getting overheated. These stocks went on an absolute heater for a couple weeks, and now they're just pulling back naturally to some technical support levels, like the 50-day moving averages on a lot of these. Totally fine, nothing to worry about. The bigger picture is that we have, as the HSBC news illustrates, we have entered the era of commercial quantum. Commercial quantum is here. Quantum computing Massive foundational change in the underlying architecture of computers. The entire world is based on computers. So we're talking about a foundational change in the underlying architecture of everything you know. Massive, massive deal. It was a science lab project for years and years and years and years. And as much as we wanted to get it out of the science lab, it was stuck in the science lab. There weren't stories about real world applications of quantum computing, about quantum computing adding commercial value to corporate organizations. That didn't exist until 2025. This has been the year where quantum has gone commercial. We have entered the commercial quantum era. HSBC, that's a great example of that. But I mean, there's more. Um, Pulling up a list that I have right here of things. Yeah, so we got that HSBC news. Ford, automaker. So Ford's Turkish division announced earlier this year that it had developed a hybrid quantum application for live production of its vehicles because they wanted sequencing 1,000 vehicles on the Ford Transit line took about 30 minutes. With the quantum computing introduced into it, the new quantum algorithm for it, they took that 30-minute sequencing of 1,000 vehicles down into 5 minutes. So they took a 30-minute task and made it a 5-minute task. Massive, massive value add for Ford's Turkish division. Really, really big news. Kind of like the HSBC thing. What was it? A 30% improvement in the bond pricing accuracy or something like that?
Right.
Right. So these are big numbers. We're talking, 30% improvement in pricing accuracy. What is that? An 80% decline in the time it takes to sequence 1,000 vehicles. These are meaningful value adds. IonQ also teamed up with AstraZeneca and AWS and Nvidia in June. It was to do what did they do? They simulated a hybrid quantum classical workflow more than 20 times faster than classical pipelines alone could for a complex chemical reaction known as the Suzuki Miyara coupling. I butchered the pronunciation of that. But the story there is that, okay, here's this very complex chemical reaction that takes a ton of time to do, which is important for drug discovery. You need to synthesize these things, simulate these things to come up with drugs. Now we're using quantum to do it, and we're simulating those things 20 times faster than we previously could, which means if you kind of extrapolate that out and we do it step after step after step, a 20 times improvement in the speed or the time it takes to get new drugs to market, to formulate new drugs. Massive deal. That happened in June of this year. Um, Also in June, a company called QCTRL used quantum optimization to schedule trains at the London Bridge station off in London. Now, what the system did, the results were it solved 6 times larger problems than any previously run, effectively accelerating the timeline to practical commercial advantage by years. So we're talking a 6 times improvement over there with London train scheduling. These are big numbers. So they're kind of small examples, right? Accelerating the simulation of one very complex chemical compound and for one company. London train station scheduling, the Turkish, the Ford's Turkish division. Like these are small examples, HSBC bond pricing, small examples, but meaningfully large results. And what that tells me is we are at the inflection point. We are at the inflection point where quantum goes from it was a science lab project. 2025 is a year it shows real world value in these kind of niche applications. And that means 2026, 2027 are going to be the years where those niche applications blow up and go mainstream. 2026 and 2027 are the years that quantum goes mainstream. And as quantum goes mainstream, the red hot rallies we've seen in quantum stocks like IonQ, like QUBT, like QBTS, like RGTI, the quantum 4 as I call them, those red hot rallies get hotter and hotter and hotter. These are stocks that, like most great AI stocks these days, are buy on all dips type of stocks. So that's my outlook on quantum. They are having a bit of a retreat right now. Wait for technical support. Wait for the 50 to show up in a lot of these names, 50-day moving average, and then buy the dip at the 50-day. I think that's a great strategy for these stocks.
Fascinating. Yeah, I am really excited about quantum. It's just it feels like the actual next step into the future for society at large.
Yeah, it's just again, it's a foundational change in the underlying architecture of everything the world is based on. Everything we do. We are recording this podcast on computers. You sent me a link to record this podcast through a computer. We sketched out the topics we were going to talk about on this podcast for this podcast on a computer. People are consuming this podcast on a computer, whether that's a phone or a laptop or a desktop computer or their TVs. They're all computing machines of some sort. Um, Everything we do is through a computer. So if we're talking about changing the underlying architecture of those computers, we're talking about changing the underlying architecture of everything the world is based on. And that has massive implications. And the biggest implication is down the line, 2 or 3 years down the line, when these quantum computing architectures merge with AI technology. That, what I call QAI, quantum AI, that's going to unlock so much value because all of a sudden LLMs, look at how fast these LLMs are improving. It's sensational. The new instant checkout with OpenAI, with ChatGPT, Sora 2, these tools are amazing. The progression of LLMs is outstanding. I think research shows that the length of tasks that LLMs can complete is doubling every 7 months. So we are already seeing exponential growth in LLMs, but even that exponential growth is being limited right now. The great limiting factor in AI growth is AI compute supply. We don't have enough compute supply. That's why this bazooka, these $400 billion, the AI hyperscalers are spending all this money they can to build more supply, acquire more supply, attain more supply, because supply is the great limiting factor. If we all of a sudden switch to quantum architectures and we have QPUs, quantum processing units, underlying this whole boom, that limiting factor doesn't become quite so much of a limiting factor anymore because quantum chips are exponentially more powerful than classical chips. So if we swap out all the classical chips with quantum chips and then add all this quantum compute capacity on top of our existing capacity, boom, there is no limiting factor on how good AI can get. And that's when you start to see, you think AI is moving fast right now, it's going about 20 miles per hour. If we get to QPUs being ubiquitous, we're going at 100 miles per hour. We're going at 120. We'll get pulled over by the cops, but we're going 120. And that is the asymmetric upside bet on AI and on quantum. And it's also why, again, I have this outlook that stocks are going to melt up over the next 12 months and then crash, between 12 months and 24 months. And that crash lasts about 2 to 3 years. But I think that crash ultimately creates the best buying opportunity in the history of the stock market. We're going to get washed out in 27, 28, maybe into 29. And you're going to get a fabulous buying opportunity because then quantum's going to merge with AI. And you're going to have this massive growth in AI development and this huge secular growth in AI stocks. So long term, I am not bearish at all. Short term, I am bullish. Medium term, I am bearish. Long term, I am bullish. And one of the reasons why is quantum AI.
Gotcha. Now, if you could humor me real quick, Luke, the total market cap of the quantum four, as you call it, is around almost 40 billion or so. What could you give us some back of the napkin math on like what happens when that bazooka of AI capex is put into the quantum four?
Okay, so what is Amazon? So Amazon's market cap, Amazon's in the trillions of dollars, Microsoft's in the trillions of dollars, Google's in the Alphabet is in the trillions of dollars. Now I get these companies have more than their cloud compute businesses, but I would say AWS, Microsoft
Hmm.
Azure, and Google Cloud are all worth more than $1 trillion. I think that's a fair thing to say. I think
Yeah,
all of
definitely.
those businesses standalone are worth more than $1 trillion. Quantum compute, I mean that's the classical compute market cap. Call it 3 trillion plus. Why can't quantum compute get that big? Or if not that big, half that big, a third that big. Let's say classical compute market cap just among the big three is 3 trillion. One third that size is 1 trillion. You just said total market cap of all the quantum four is 40 billion. So then we still have growth from 40 billion to 1 trillion, right? That's the asymmetric upside bet on quantum. If this stuff does become, even a third, even a fourth, even a fifth as big as classical
Right.
compute, there is massive growth runway ahead for the main players in quantum, which is why you cannot value these stocks based on what are their sales in 2025? What are their sales in 2026? You can't look at these stocks on a trailing 12-month basis or even a forward 12-month basis. You have to look at these things top down, the potential, the total addressable market of these folks, and how much of that can they attain. So a company like IonQ, let's say the entire market goes to $1 trillion. Can they attain a third of the market, a fourth of the market? Absolutely. So you're talking 250 billion, 300 billion, $350 billion company. Sounds pretty good to me. That's a lot of upside from where we currently are. So that's why I remain constructively very bullish on the quantum stocks.
Amazing. Now, I do want to touch on something you mentioned a little bit earlier about ChatGPT's essentially having an instant checkout in the app. They struck a deal with
Right.
Etsy specifically, and I believe they're in the works with a deal with the e-commerce giant Shopify. And we know with technology or specifically apps, websites, the stickier they are, the better. Gen Z reportedly doesn't even use Google anymore; they use ChatGPT. So what does this mean for the market share for other e-commerce giants like PayPal and what have you now that ChatGPT is stepping into that domain?
Yeah, they're for lack of a better term, I don't want to curse on the podcast. They are fricked. They are
Mm.
SOL. They are in a bad position. Um, the we talked about this before. LLMs again, they're progressing so rapidly. They're becoming so much more capable, so much smarter, so much more autonomous that they are eating the software world. There are
Yeah.
so many stocks out there that are getting hammered. They were formerly AI winners that are getting hammered now because it's like, wait, LLMs can do what you are doing. Has become the poster boy of this, right? And Adobe. Those are the two poster children
Mhm.
of this LLM encroachment that ChatGPT can now whip up language learning apps. So Duolingo is trying to sprint ahead and stay ahead of this LLM encroachment by going into music and math. And, they're a very innovative management team. And I like that management team. I think they're very capable, but they're fighting an uphill battle. The LLM it's on Duolingo's heels. Same with Adobe. Adobe, great management team, great business, considered one of the safest businesses for the longest time, one of the most well-run businesses, a company that was consistently growing revenues 10, 15, 20% year over year, compounded 90% gross margins, 45, 50% operating margins, cash flow giant. Everybody thought was a super wide moat. All of a sudden, not so wide, right? Nano Banano from Google, Sora 2, these apps. Why do I need Adobe anymore? You open up Adobe and it feels like 10-year-old software. So the LLM encroachment is very real. And this is another example of that. Instant checkout is another example of LLMs. They're going to keep encroaching on other folks' territory. They can't get this big, eat this much market share without hurting. And they're starting to rub elbows. The thesis was that the AI boom is going to be so big and grow so quickly that it's going to be a while before competitors start to rub elbows. No, the LLMs are now growing so quickly that they are already rubbing elbows with a lot of people. And more than rubbing elbows, they are beating them down to a pulp. Duolingo stock has been beaten down. And again, that is one of the most innovative, and I think I respect the heck out of the management teams out there. And they're still getting beaten down. Adobe, beaten down. With this instant checkout, PayPal, beaten down. Like eBay, beaten down. Why would I go anywhere else besides ChatGPT to shop now? I can chat. The thing about ChatGPT is it knows me. Everyone's like, I like to use
Right.
multiple AI models. I don't know why people use multiple AI models. I think that is so dumb. You want to use one AI model because you want that AI model to know you. Memory in AI models right now is decent. It's only going to get better. Once the memory does get better and you get a fully fleshed out memory, if you have a database of usage for it to draw on, it's going to know you better than your wife. It's going to know you better than your kids. It's going to know you better than your best friend, better than your parents. It is going to know you better than your therapist. This AI is going to know everything about you. So if I have this AI that knows everything about me, I can go to it and say, "Hey, I'm looking for a shirt to wear to a date on Friday night." And that's probably all you have to say. And it'll come back with exactly what you are looking for. It's going to know you better than you. And then you just click, okay, cool, bye, right there on the platform. Yeah, that means massive market share loss for companies that are not a part of that deal. Now they are building on top of, I think Stripe is the company that they are
Right.
building with. So there are payment rails that go into this. It's not like OpenAI is going at it completely alone and everyone gets axed out. Shopify is involved in the partnership. Etsy's involved in the partnership. So it's not like OpenAI eats the whole e-commerce industry. But what it does mean is that if you're not involved in that purchase flow, then you're probably going to lose market share over the next few years, and your stock's probably going to struggle. PayPal in that boat. Some buy now, pay later firms probably in that boat. Square, Block probably in that boat. Unless they strike some big partnerships with some other foundational AI models, some other LLMs, I don't like the outlook for those stocks. So again, this is just another example of LLMs getting so much better, so much more capable. They're eating the rest of the world. And stocks that formerly looked like winners are now turning into losers because LLMs are doing their jobs better than they did their jobs. How do you avoid this when investing? You want to find companies, appliers, AI appliers, as I call them, that are applying AI to highly regulated, wide moat industries that have high barriers to entry. Insurance is a great example. You're not going to use ChatGPT. Big companies are not going to use ChatGPT, no matter how great it gets, to price policies. And the government probably wouldn't even allow that. It's a very highly regulated industry. So a company like Guidewire Software, GWRE, one of our favorite AI appliers, has a big competitive moat protecting it from LLM encroachment. Axon, the law enforcement technology solutions provider. Again, we're talking law enforcement stuff here, police tech, security tech. This is not stuff that you're just going to hand off to an LLM. This is stuff that requires, there's a lot of regulation, a lot of hoops to jump through, a lot of hurdles to jump over. So something like that is completely safe. So I want to look for stocks that have that sort of protection when looking at the AI application layer. And that group's becoming increasingly narrow because LLMs are getting so much better at just doing so many different things, and it's not going to stop anytime soon.
Definitely. Yeah, you have the rise of vibe coding and all sorts of things. And I
Right.
think there's one thing we know about the consumer is that they're usually going to follow the path of least resistance. If I don't have to leave an app, why would I, right?
That's exactly right. That's exactly right. You just want it's seamless, right? This is why
Yeah.
Amazon beat a lot of other retailers that you even try to go online. Like it's all in one place, all in one place.
Definitely. Now, I do want to jump back to the government just one more time, Luke. We talked way back when about the administration kind of cutting down on Nvidia's exports to China. You know, famously, they can now only ship over the H20 chip. And one of the
Right.
concerns there is that Chinese competitors would now increase production to counter Nvidia's high-end chips. And now we're seeing that with HuaWei. They've doubled production in their high-end chips because of the constriction of the NVIDIA exports. Now, what's your take on that, Luke?
Free Nvidia. Free Nvidia, free the chips, right?
Yeah,
That's the movement we need to embrace. No, I mean China's going to get their hands on AI chips no matter what. Okay,
regardless, right?
so
Yeah,
I we may as well have them be American chips as opposed to Chinese chips because all they're doing now is so now Huawei's going to win all that business and now China's going to get Chinese companies to get all that money. That's not good. That's not great. And then also when you force a company into a supply shortage like that, they get really innovative and they come up with solutions that may beat our own solutions.
Mhm.
That's what we saw with DeepSeek, right? We put all these export
Yeah.
controls on NVIDIA chips, and all of a sudden they found an innovative loophole to make it work without so many chips, and it really scared the crap out of a bunch of U.S. companies. Now, U.S. companies have since adapted and adopted a lot of those methodologies into their own frameworks, and now there's a big shift from training to inferencing. But the point being, yeah, just free NVIDIA, free the chips. They're going to get their hands on top AI chips, so may as well make them American chips and not Chinese chips. And two, don't force them into being more creative. Creativity, innovation is what leads to massive breakthroughs. Don't force them into that. Just give them the chips and let them be lazy. So I think that, yeah, I think we just need to free these chips up. I think it's very short-sighted and very dumb that we have the export controls that we do. It's time to let NVIDIA sell, and it's time to get everyone on the same playing field and allow NVIDIA to have more success, because that's more money NVIDIA is going to have to invest back into US AI infrastructure and stuff like that. The US wins more when those export controls are lifted than when they're in place. So I would say remove them. That's my straightforward thesis there.
Awesome. And then on the other hand, we do have certain bills coming through the Capitol Hill Genius Act and the Clarity Act, and these
Right.
are essentially creating the pavement, the runway for stable coins and cryptos to be more prevalent and ubiquitous in the market. Now, Luke, you mentioned that this is the way for America to become financially independent, which I
Mhm.
thought, very, very, very bold term phrase there. What did you mean by that?
Yeah, so I'm very bullish on the stablecoin movement. I'm very bullish on what's happening in DC to support the stablecoin movement. Obviously, there are a lot of changes happening in DC with this administration. Some of them good, some of them bad. Everyone's got an opinion. I think one of the things that is almost unequivocally good is their push for further stablecoin adoption. And the reason is that stablecoins can be the ticket to America finally achieving true financial independence, true financial sovereignty, because we're not financially independent right now. We are not truly financially sovereign at the current moment. And the reason we are not is because we are a debt fueled economy, and a big portion, about one third of all our debt, is owned by foreign creditors, foreign entities, the Chinese government, the Japanese government, Chinese investment funds, Japanese investment funds, Saudi Arabia, the Middle East, throughout Europe. All of these countries and foreign investors, they own a bunch of US debt because it was the best thing to buy for a long time, the most risk-free thing to buy for a long time. Still is probably the most risk-free thing to buy. So foreign creditors gobbled it up. That's a problem because, one, again, we are a debt fueled economy. We have so much debt out there. All of our growth is fueled by debt. There's nothing wrong with leverage per se. Some of the greatest companies of all time were massively levered up and had great success. Real estate investors, they get massively levered up. They go out and buy properties. They have great ROI. But when the person on the other side of that leverage is someone who doesn't necessarily have your best interests at heart or may not have your best interests at heart, that's a problem. As much as people love to hate on banks, mortgages work because banks don't really want you to foreclose. Okay, it's a mess on their end if you foreclose and they have to take ownership of the house and they have to sell it. Like, there's just a lot of costs that go into that. They're not going to make as much money. They're going to make much more money if you get into your 30-year mortgage at 5, 6, 7%, and you just pay it off over 30 years, and they get 7%, 5%, 6% interest on that over 30 years. That's the easiest path for them. They want you to succeed as the lendee, or as the lender, sorry. Um, that's not true with America's situation right now. Specifically China. They own a lot of our debt. They can unload that debt to kind of manipulate our policies and our decisions. Trump calls it financial blackmail. I think that's an appropriate term for it. It is
Right.
financial blackmail. I think one of the reasons that we've backed off so much on tariffs, especially with China, is because we realized they could start dumping. And if they start dumping, the long end of our curve is going to spike up. 4% 10 years is going to become 4.5, 5.0, 5.5. They can dump a lot. We don't have buyers to come in there and absorb that supply. So you would just have massive selling pressure. You would have a huge price decrease in our debt, and you would have a massive increase in the yields on that debt. That's massively problematic when we all got mortgages, we all have auto loans, we all have these things we got to pay off. All that stuff goes up. Man, the economy absolutely craters. So it's financial blackmail. And this is increasingly important because we're in a race with China. We're in the AGI race, maybe the most important race of all time with China. Who's going to develop AI first? Super AI, super intelligence, artificial general intelligence. Who's going to develop that first? If we're in that race and they have this financial blackmail over us, and at any point they feel super pressured, they can unload our debt, and all of a sudden we have to take a time out from working on AI to fixing an economy that's breaking or broken.
Hmm.
Because of these things, the stakes are far too high for us to be a victim to this financial blackmail. We need a route for us to become financially free from the leverage that foreign creditors have over us. Stablecoins create a pathway towards potentially achieving that. Because what stablecoins do, right? What is a stablecoin? A stablecoin is essentially a crypto that is backed one to one by a stable asset. In many cases, in most cases, backed by US Treasury notes, by treasuries. So that means every time we have a stablecoin issuer and they come out and they issue a stablecoin, they issue 100 stablecoins, that means they got to go and buy 100 treasuries. They issue a million stablecoins, they got to go and buy a million treasuries. Every time they issue a stablecoin, they have to become a buyer of treasuries. So if we create a framework for stablecoins to become massively deployed throughout the US economy, Amazon's deploying them, Walmart's deploying them, Target's deploying them, Uber's deploying them, and all these big multinationals that are doing tens of billions of dollars of transactions every single year are deploying stablecoins. Then we have tens of billions of dollars worth of stablecoins, maybe even hundreds of billions of dollars, trillions of dollars worth of stablecoins now circulating throughout the market. That means that these stablecoin issuers like Circle, like Tether, they have to go out and buy trillions of dollars worth of treasuries. That is the buying mechanism we need to keep ourselves safe from a supply side shock, if you will, a sell side shock from China. China, go ahead and sell all your treasuries. Do it. We have stablecoin issuers here to now buy them up. They're automatic buyers of treasuries. And so this is a route for America to become truly financially free, truly financially independent. I think it's a massive, massive deal. And I am very excited that things like the Genius Act, the Clarity Act, are moving forward on Capitol Hill and creating a legal framework for this stuff to have not ubiquitous adoption, but mass widespread adoption in 2026, and at least start us down the pathway towards becoming truly financially free. It's a massive deal. I think there's huge investment opportunities in it for a company like Circle, for some, payment rails companies. Solana is a big one here. I think there's a lot of opportunities in the crypto world and in the stock world as this stablecoin universe grows into something that's going to be a massive piece of the U.S. economy.
Definitely. Okay. Now I want to move on to one of our favorite stocks, Opendoor, Luke. Just want to get another update on that one, specifically because I recently read a couple reports that indicated for the average consumer, their pay needs to go up 70% for the housing market to be viable again. What's your weekly update on Opendoor this week?
The weekly update for me is one massive insider purchase from Eric Wu, the former founder who is now back on the board. I think he purchased $2 million worth of stock. It's a pretty big deal.
Sure.
That's a lot of money. So that's very bullish. The Eric Jackson versus George Noble feud on Twitter X is pretty funny. I don't think it moves the stock. I think it does show retail energy and engagement. So I think ultimately that is a good thing there. And then three, I think with the state of the housing market, um, I think there are concerns out there that the long end of the curve is not going to much lower. And so I do think people are coming back into the market. We're seeing mortgage applications jump up, and we're starting to see the purchase side of it rise a little bit as well. I think that's all good news for Opendoor. So I remain a believer in Opendoor. I remain a believer in what's going on. I really like the insider purchase. I do think the stock will continue on its run. But again, the stock went from 50 cents to $10 overnight. It's not going to go from $10 to $50 overnight. This is the hard part now. This is the
Right.
grind. I think it's going to grind higher. We're not going to vertical shoot up to 50. I mean, never say never. We might, but my best guess would be now we grind higher. We got to that $10 level. We're kind of retreating from that, but $10 becomes a new kind of like anchor or magnet for the stock. It goes a little bit higher, goes a little below, and then I think we trend up to 15, a little bit higher, a little below. Then we trend up to 20, a little bit higher, a little bit below. I think we now move in increments, not in a straight line rocket ship higher.
Awesome. Okay. And now let's move on to our breakout stocks of the week. The first one we talked about already in this podcast, and that's Intel.
Yeah, Intel looks pretty good to me. I think Intel is I mean, they just got AMD as a customer, I think is the latest news. So there's good news flow here. When we look at, the technicals, the stock is moving significantly higher, obviously. It's breaking out above some big levels that were formerly resistance, and it's kind of just clearing right through those. I think, again, part of the president's portfolio, this is going to get a lot of support for the next 3 years at least. So I do think I think the Intel comeback story is very real, and I think we are in a stage two breakout for the stock that takes this stock. I mean, if I had to put a price target on it, I would say, I think we definitely come back to these levels right around 50. I think we easily retake that. And I think retaking, these highs from back in 2020, 2021, $70, I think that's entirely possible in the next 12 months. So I wouldn't be surprised if Intel stock doubles from here.
Cool. Next up, we got an energy stock, Fluence Energy.
Yeah, energy storage stock got wiped out in the energy storage kind of doomsday scenario back in 24 and 25, but now it's coming back to life as it looks like energy storage might play a big component in the AI data center build out. Bloom Energy is the big winner here, but Fluence could win as well. So basically, what's happening is okay, all these AI data centers getting built and they're tapping power from the grid, and that's all fine and dandy and great. But what we also need is backup power. What if the grid goes down? We need backup power, on-site backup power for these data centers. Fluence can provide that. Bloom Energy is providing that. That stock is soaring like crazy. Fluence could be next in line. Fluence is one that a lot of people kind of threw in the towel and said, oh, solar is dead, so storage is dead too. No, just because solar is dead doesn't mean storage is dead. Fluence is showing you that storage is not dead. I think this one could win some big AI data center contracts over the next few years. I think this stock could easily reclaim its $20 to $30 highs that it had just 2 years ago. So I think we can get back to those levels. I think this is an AI story now.
Awesome. Next up, Triple D, 3D Systems Corp.
3D printing. I've been burned bad by 3D printing in the past. So I am biased here. I don't like it. 3D printing is always that technology that's 3 years away from being 3 years away. I mean, look at this stock. It has a history of pumping and then dumping. Uh, all the way back, actually, if you go all the way back to 20, yeah, there you go. So this is the big 2011, 2012 run, massive spike when it was going to be the next big thing. I think Obama talked about it in a speech, and then it didn't, gave back all those gains, boom, went nowhere for a while. Then we had the COVID boom. Next big thing, 3D printing is going to change everything. Maybe it's not, maybe it will. Nope, it's definitely not. And now we're back to zero again. And now we're regaining some. You can't even see the breakout here when you look at the chart zoomed out. But when you zoom in, you can see the breakout. I don't like it. I don't think 3D printing is ever going to be that big when I actually look at, maybe in some rockets, use cases are small. But I'm just 3D printing of homes, maybe, but we're not there yet. I don't like 3D systems all that much.
Right. Okay. And then on to the final one, American Battery Technology.
Ooh, we actually had this one in one of our breakout portfolios, and the stock has gone vertical. Good for our subscribers. Um, yeah, fantastic breakout. Can it continue? I think so. Resource plays have been on fire because when you look at the president's portfolio, What it's resource plays. I mean, Intel's not, but MP is, LAC is. So they're going after resources. So now who got next, right? Like that's the question. Who
Mhm.
got next? Well, ABAT's certainly a contender. Lithium kind of metals miner, battery maker, iron, they're in that whole world. You're seeing them take off. You're seeing NB take off. You're seeing a bunch of these kind of resource plays really catch fire. I don't think this rally's done. I think these resource plays, we're kind of entering a resource golden age, if you will. If America really does want to reshore, really does want to create domestic value chains for artificial intelligence, that means a lot more growth in the resource sector, U.S. resource sector. So I think ABAT, as hot as it has been, can stay hot.
Fantastic. All right, that wraps up our breakout stocks for the week. And now, as always, Luke, do you feel like there's anything we might have missed in our conversation this week that is relevant to our subscribers, viewers?
We covered a lot of ground this week, like we do every single week. No, I don't really have anything, Brooke. I'm happy with the conversation. I'm happy we're able to take a balanced approach to how we look at things. Super bullish on AI, obviously. I think the next 12 months are going to be great, but no boom lasts forever. Beware of the bust risks. Beware of what to watch for to be sure that you don't fall victim to the bust. Make a lot of money over the next 12 to 24 months as long as the boom lives. Cash out, save yourself from the crash, use that cash to buy the dip on the other side, and then ride that secular AI boom higher for as long as that one goes. So, yeah, that's the outlook. Same as last week, hasn't changed. I just think there's some nuances. Resources really really hot. Energy storage starting to have its moment for AI. I think these are kind of the wrinkles in the AI trade that you got to pay attention to if you really want to catch the biggest winners as this trade evolves into much more than just the hyperscalers.
Awesome. And then before I forget, we did have a question that I found interesting in our last episode. We haven't mentioned Bitcoin as of late, but there is that 4-year cycle of Bitcoin. And the next year, 2026, is the projected bad year. Uh, one of our subscribers did want to get your take on that.
Yeah, the 4-year cycle, right? The 4-year cycle. Yeah, 2026 is the projected bad year, if you will. Not starting right away in 2026, but starting at some point, summer 2026 is when you're expected to have that quote unquote bad year, because the 4-year cycle of Bitcoin around the halvings. The two reasons this could be different this time around, and I think will ultimately be different this time around, though I'm not holding my breath, is to say, hey, you know what, this time is definitely going to be different. But one of the reasons it could be, two of the reasons it could be rather, one, you have institutional investors in the game now. Institutional investors own a lot of Bitcoin, and that allocation is growing. Institutional money does not move as fluidly as retail money because retail money, when you move money, there's fees. The smaller the money you move, the smaller the fees. The bigger the money you move, the bigger the fees and the tax implications. So, because of that, institutional money is much more like a rock in the sand. Retail money is like the tide that comes and goes every single day. Retail money drove the boom and bust cycles of 2012, 2016, 2020. Um, Institutional money's driving things now, or at least driving a bigger portion of things now. That implies more stability. Number two, you do have real world applications starting to come into the fold, specifically with stablecoins and tokenization. Those real world applications could put in a durable bid under cryptos, at least cryptos tied to those two vectors of growth for the foreseeable future beyond this boom bust cycle that's been repeatable ever since Bitcoin's inception. So for those two reasons, although 2026 is historically supposed to be the bad year for cryptos, I think that this time could be different because of fundamental distinctions between this cycle and previous cycles.
So that means no 80% dip buying opportunity on Bitcoin ever again, right?
I don't I mean I think there will be dips along the road and there will be some big ones, but I do think the days of 80% crashes in Bitcoin are over. I think institutional investment precludes that from happening.
Gotcha. Okay. All right. I think that wraps up this week. I want to take a moment to talk to subscribers, send in your questions. We're happy to answer them. We want to make this community grow the platform. But that has been another week of Being Exponential with Luke Lango. We've enjoyed our time. I hope you've enjoyed watching. We'll see you next week.